and welcome to Business Television India. I'm Fatima Mehdi and you are watching Financial Planner. Joining us on the show is Feroz Aziz, the Deputy CEO, Anand Rathi Private Wealth Management. Feroz, wonderful to be talking to you right here on the show. Let's today talk a little bit about what's happening with portfolio management services, PMS as we name them. We understand that a SEBI working group has proposed quite a few changes to make PMS services in India more transparent and investor friendly. Firstly, tell us exactly what has led to this situation.
See, I think PMSs, Fatima, are portfolio management services generally meant for HNI investors, which were actually incorporated or brought into effect in 1993. So it's been about 26 years of PMS's existence in India. But largely at the end of 90s, this took some shape in the form of a few initial PMS providers actually coming into the market. So point one is PMS is a 26-year-old vehicle. Point two is that PMSs actually suddenly grew in size after mutual fund commissions were brought down in 2015. So for the first 10-15 years of its existence, or even 20 years of its existence, it hardly had assets. But in the last 4 years, I think the assets have actually become 40 times, 30 times from where they were just about 4 years back. This was an eye-popping number, and this incidentally coincided with mutual fund commissions being capped at 1%, and now the trail incomes. Now mutual funds actually don't even pay upfront commissions from October last year, after that circular implemented this year, of course. So point one I'm making is it's an old vehicle. Point two I'm making is it's today become a very large AUM, asset under management in the PMS service, because advisors have started skewing their clients' portfolios to PMSs. Point three is that was the most non-transparent vehicle, in our opinion, is why for the last 6-7 years we have been a complete no-no when it comes to PMSs. I think this is a very progressive circular. This is a very much needed kind of circular. It has made several observations, in fact 20-25 observations, which are important. So that itself says that where we were and where we want to go, there's a large disparity between what is desired and what is actually delivered before this could come into effect.
Feroz, you've touched upon this, but one of the biggest concerns has been the lack of standardized and easy understanding reporting formats, which we've also amounted to lack of transparency with regards to fees and charges. Specifically, how has the kind of suffering we've seen in mid and small caps also hit PMS products? And also, how has this sort of enabled this whole scenario at the moment?
Yes, so I think very important first question which you asked me, Fatima, in terms of reporting. I think for a prospective investor or a current investor, reporting becomes a very important variable, which was not standardized. What happens in a PMS is you have individual accounts for each individual. So there are different methods each of these PMS providers were using. Someone used the first portfolio, somebody used the average portfolio, somebody used the model portfolio. Everybody had different mechanisms which favored them to report in the format which they love to see and which they want their prospective clients to see, so that there is a little degree of not window dressing but a massage of data to make it a more lucrative case for an investor to invest. So investor was ending up comparing apples and oranges when it came to mutual PMS selection, which the fund manager would portray a different mechanism. So point one, transparency with respect to same reporting standard wasn't there, which is shocking to me, which is a very large industry where you don't have a standardized reporting. The frequency of reporting was once in 6 months, whereas on the contrary, a mutual fund needs to report every day. The NAVs get published on the same day before the next day comes into picture. So by 8-9 in the night, you have all the NAVs, most of them at least, on the AMFI website. So from a 1-day reporting to a 6-month reporting is what is the kind of difference we used to see. And third, once there was a reporting, there was no audit to that reporting. most often than not, PMS providers would not audit that and give a stamp of the auditor, because in a mutual fund there is a huge kind of regulation in terms of the transparency and the sanctity of the reporting. So standardized reporting, frequency of reporting, on audit, all of these three were missing with respect to transparency. This was one of the largest reasons why I have been personally very negative on stock PMSs.
Firoz, just a little bit more about how they're planning on regulating this whole scenario. I understand that it is recommended an increase in the minimum net requirement for a PMS manager from 2 crores to 5 crores. But the amount proposed is still dramatically lower than mutual funds. Tell me how this actually works. I understand an asset management company running a mutual fund is required to have a minimum net worth of 50 crores. What is the significance of this?
Fatima, I think you've touched upon a very, very valid point. The setting up of a PMS is significantly easier for a person or a corporate than setting up an asset management company. You have just about less than 42 AMCs, which are mutual fund houses, but there will be maybe, I don't have the exact count, but 20 times more the PMS providers in the marketplace. So the point I'm trying to make is when you have an entry barrier which is so low for a manager to become a manager and provide his or her service to a larger community, the entry barrier was reasonably low, transparency was reasonably low, which is a very bad, deadly combination. Anybody can come in with very small entry barriers and can be non-transparent with respect to prospective clients or clients already. So that is a good move. The net worth having to be moved from 2 crores to 5 crores is anyways not a very large change, because 5 crores is not a very large amount for a person to set up a PMS. But I think it's a good move in the positive direction to create an entry barrier of reasonably large sized players only, and not small time players who are aspiring entrepreneurs who want to try their hand at fund management.
Okay, all right, fair enough, Firoz. Just in terms of the changes, in terms of the investment approach that is being talked about, the principal officer of the PMS, I understand, also has to really be much more answerable to clients. Marketing materials, websites, all of the information that's out there should be reported to SEBI. This is something that is a demand of the working group. How possible is this, and how quickly can it be executed, do you think?
See, I think it's of course possible, but it's again one very good step in the direction of bringing the principal officer with certain degree of capability and accessibility. So I think it's a very good move. I think it is just to strengthen the whole concept of portfolio management service. So it's a very good step in the direction. So I think it is definitely possible. It's not a big deterrent for a person who's very serious of offering the service to manage money for the larger community of investors. So I think it's a very good progressive step, just brings in more capability and filters out small time players who are not capable of managing money for a group of investors. Managing your own money is a very different ball game than managing money for investors. So I think this is again a very good step in terms of making the system more robust for the investors to not take undue risks by entrusting their monies to the wrong hands.
Sure. Firoz, a little bit about the fee structure. I understand that one of the recommendations of the working group is that in the case of performance fees, they should be levied without a catch-up basis. Can you tell us a little bit more about what this means, what this methodology actually means, and what is it that they ultimately want to achieve?
Yes, unlike mutual funds, PMSs were permitted and currently are yet permitted to charge something called a profit share or a performance fee. Now what used to happen was, if let's assume a client has made 15% return and the market has delivered 12% return, so the fund manager generated 3 more than 12. But the profit share, let's assume there was a profit share of 20%, which quite a few PMS managers have, then the client gives away 20% of the 15, which is 3% again, and comes back to 12. So what is a performance-based fee? Performance-based fee is nothing but a portion of profits being given away to the fund manager over and above the expense of the fund in case of a good performance. So that's point one. Point two, whenever there used to be a performance fee, there used to be something called, and there currently is something called the hurdle rate. Hurdle rate is nothing but the interest or the return below which you don't have to give any performance fee. Once you supersede that hurdle rate, let's assume it is 10% as the hurdle rate. If the fund actually delivers 11%, you are supposed to give a performance fee. If it generates 9.5%, which is lesser than the hurdle rate, you are not, the fund manager is not eligible for a performance fee. So now what is catch up? Catch up is nothing but once the 10 is superseded, the performance fee on the entire 11, if given, is called a catch up. If the performance fee is only on the incremental from 10 to 11, it is called without a catch up. Catch up is nothing but a phenomena of paying a performance fee once the hurdle rate threshold is crossed for the entire return is called catch up. Only for the differential return is called no catch up. So the proposal is to not have a catch up and penalize the investor for the profits made in the first 10-12%, which is generally the hurdle rate.
Feroze, just a last question I have. At the moment, I understand that PMS managers are also investing in unlisted securities as well. And one of the demands is that the working group is proposing that the PMS manager should only be allowed to invest in listed securities. Tell me a little bit more about this, and also finally, how soon you think these changes are going to actually all come about?
Yes, so I think unlisted securities can have a large problem, especially in the equity side. On the bond side, if you are investing in unlisted securities, it's okay. But on the equity side, unlisted securities can have a very large price variation. Price discovery is very low. So on the discretionary platform, unlisted securities not being bought is a good idea. But on the non-discretionary platform by which you imply that the client takes the decision, not the portfolio manager, that's called non-discretionary. There I think it should be permitted, and I think that's what will be the submission of the intermediaries group before August end or September. Till this is just a draft circular. Before it gets finalized, I'm sure there will be representation from the industry. So that answers when and unlisted security. But it's important to understand why SEBI formulated this, because the amount of risk these PMS portfolios carried in terms of standard deviation, which is a measure of market risk, was significantly more than what a mutual fund takes. So you have a higher risk, concentrated portfolio, non-transparent with low entry barrier, higher cost, profit shares, all this put together, it desperately required regulatory intervention. And the last bit, the differential in fee for the intermediary was humongous in terms of upfront fee, which will now get normalized. So the last 3-4 years, you have seen advisors who were recommending 10% in PMS today recommend 40% in PMS, because PMSs could have 4-5-6% upfront fee. To increase the profitability of the advisors this year, profitability, people used to skew their portfolio significantly on PMS. I'm glad that most of the financial instruments are coming to parity with respect to intermediary commission, and trail commission is a very, very good client-centric thing, which is what the proposal is.
All right, that was Feroze Aziz, the Deputy CEO, Anand Rathi Private Wealth Management. Thank you so much for this conversation, Feroze. And that, of course, is how we are closing this episode of Financial Planner. Thank you for watching.